Newfound Gold has discovered what some are billing as potentially Canada's most significant discovery in the last decade. Hole NFGC01 revealed 19 meters at 93 grams per ton, starting at only 96 meters downhole. With over 70 million in working capital, Newfound Gold is well positioned for what the future brings. To learn more, find us online at newfoundgold.ca.
Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is returning guest Michael Pento. He's the president and founder of Pento Portfolio Strategies. He's also the author of The Coming Bond Market Collapse. He's a specialist in all things U.S. economy-related, inflation, GDP, and unemployment. How are you today, Michael?
I'm doing fine, and thanks for having me back on the program. Good to be with you, Tom.
Great to have you back. Going through some of your last letters, you write a weekly letter, and I found a line that really stuck out to me from about 3 weeks ago. You say, "We're in an economic equivalent of a person bouncing off a trampoline after a 1,000-foot cliff dive." And that just makes me wonder where you see we are in this quote-unquote recovery, as the Fed can call it.
Well, I mean, I predicted that this would happen. So, I went short in the portfolio. I run a long short portfolio. So I was short in the portfolio starting January 24th is when I really saw some of the high frequency components of my model, my 20-point model, indicating trouble ahead, even though I had no idea how deep and how pervasive the Wuhan virus would become. And then sort of around, we had the disaster April, the disaster that was early May. But then June, late May, June, we saw a very sharp recovery in the economy. The economy was reopening up, and we managed through the CARES Act to spend $2.4 trillion, helicopter money, checks to people in the mail, and not loans, but just basically grants to small businesses, trillions and trillions of dollars. And the Fed printed $3 trillion, too, to help facilitate this fiscal disaster. So, of course, you're going to have a bounce. I'll give you a good idea. And then I went long in the portfolio sometime around that same time frame. And then, of course, now I'm starting to get more defensive in the portfolio because the fiscal cliff that I see coming is nigh. When I say more defensive, I'm just pulling back on some longs, and I just instituted a short several weeks ago that, by the way, is not working at this moment, but it's offset by many other things that are doing fantastic, like utilities and precious metals. So where are we now? So you jump off a 1,000-foot cliff, you hit a trampoline, and you bounce pretty aggressively, but nowhere near from where you jumped off. And then you head right back down. It's exactly what is happening to this economy, and I believe the stock market's not going to fall far behind. Let me give you just one example of what I'm talking about. So new home sales absolutely fell off a cliff, of course, in April. I mean, no one was going to buy a house. No one would show their home, and real estate commissions were dead in the water. So we saw today on CNBC, Steven Mnuchin, our Treasury Secretary, saying, and reiterated by Donald Trump, I'm not being political here, I'm just saying what this political spin is, that existing home sales were the best we have ever seen in history. Now, that, Tom, is a fact. The change in home sales was the best ever in history. Now, when you measure that from zero, if zero is your base, of course, you're going to have some of the best numbers you've ever seen in history. If people who follow me for a long time predicted, I said you're going to see the worst numbers we've ever seen since the Great Depression, and in some cases worse than the Great Depression in April. But in May and June, you're going to see some of the best numbers we've ever seen in history. But here's the point. So year over year, existing home sales are still down over 11%. So this just shows you exactly what's going on in the economy. You had, past tense, a sharp and strong rebound predicated on the economy reopening from zero and massive stimulus. But what we see now is a rebound in the virus, the closing of economies, and a fiscal cliff, which is going to be absolutely devastating, in my opinion, because you just can't borrow, $2.5–3 trillion every few months and have the Fed monetize it with impunity. It just can't happen. So that's where we are in the economy.
I think maybe we can go through some of the notes from, let's say, the fiscal cliff, as we were just talking about. So you're saying July 15th, the delayed federal income tax payments are due. July 31st, enhanced unemployment insurance expires. August 31st, end of mortgage foreclosure forbearance ends. And $290 billion in helicopter money will easily be gone by now. So the question is, obviously, everybody's out of money. As you say, the fiscal cliff is here. Are we going to see more money printing, or
Sure.
is it a possibility that we can just kind of keep riding this out?
Okay, so the fiscal cliff is here, and there's going to be a delay in the next helicopter money squadron to come drop off money to your mailbox. So Nancy Pelosi and the Democrats want to spend about $3.5, I think it's $3.4 trillion to be exact, nearly $3.5 trillion more money. Now, bear in mind, the annual deficit right now is on track to be almost $5 trillion in fiscal 2020, which ends in October. So between $4 and $5 trillion, Tom, that's 20 to 25% of GDP, depending on the final number. I mean, that's Zimbabwe. That's Banana Republic type of numbers. This is before we get this next round of stimulus. Now, the Republicans only want to spend around $1 trillion. I say only $1 trillion. Now, bear in mind also that the largest deficit we ever had was $1.4 trillion in the wake of the Great Recession. I think it was fiscal 2010, which ended October 2010. So $1.4 trillion was the largest deficit, but these guys already have a $4 trillion deficit, and the only discrepancy is, well, Republicans only want to add $1 trillion, and the Democrats want to spend, another $3.4 trillion. And what I think is going to happen is there's going to be another brinkmanship, as I like to say in D.C., where they can't agree on anything until the 11th hour. So maybe the checks don't come out to people's pockets right away. One of the reasons why I have a short in the portfolio right now is because I think between now and, say, August 1st, July 31st is when people's checks stop coming, and then there's rent due. People are going to have to go into savings, stop consuming. The stock market might not like that. But then again, I think they're going to agree to something, whether it's $1.5 trillion or $2 trillion. It's going to be something to keep this facade afloat. But here's the point, and I hope I make this very clear. There is a fiscal cliff coming because you just can't print trillions of dollars and borrow trillions of dollars every few months. No economy in the history of planet Earth has ever been able to do that without destroying its currency and its bond market. So I don't think the United States is going to be any different. So eventually we're going to have this fiscal cliff, and that's why I run a actively managed portfolio. It's called the Inflation, Deflation, and Economic Cycle Portfolio. And when the next round of stimulus wears out, which eventually it must, and I think the November election might bring a lot of conflagration in D.C., maybe a contested election, maybe a bifurcated government. Let's just say Joe Biden takes the White House and you have the Senate stays Republican. I don't think the Senate Republicans are going to be in a rush to give Joe Biden trillions of dollars in stimulus. So you might have gridlock in D.C., and then the fiscal cliff comes, because what is the Fed going to monetize? The deficit's going to go from $4 or $5 trillion per annum down significantly, but still way above, before the Great Recession, the annual deficit was $250 billion. So it's not going to go anywhere near there. It's still going to be in the trillions, but it won't be $5 trillion. And that on a second derivative basis is a sharp fiscal cliff, and you're going to get some dose of reality probably in the fall of this year.
So as we're talking about the dollar and the purchasing power of the dollar when it's being obviously destroyed with all this printing, we're seeing it roll over, right? It's the lowest it's been in somewhere around 2 years. And are we just seeing quote unquote relative strength because everybody is concurrently printing the same way?
Well, look what's going on in Europe. You see, Europe just agreed to basically not only a monetary union, but a fiscal union. This is what's happening right now in Europe. And they're going to issue the equivalent of trillions of dollars in stimulus in a EU bond structure. So everybody's destroying their currency, debauching the currency pretty much at the same pace. I mean, the United States is in the vanguard in this race to destroy your currency, but every other nation is doing the same thing. People's Bank of China is doing it. Bank of England is doing it. Of course, the Bank of Japan is, leading the way in many ways of destroying their currency in their country. So it's very hard to get the dollar to get destroyed in the sense of a classic hyperinflation where you see the Hungarian Pento get wiped out. Or what happened in Weimar, Germany. So it's very hard to get the world's reserve currency to crash in that fashion. So you're not going to say, oh, I'm fleeing the dollar to run to the safety of the euro or the yen or the renminbi. That's just not going to happen, not to any great degree. But what is happening is, as you see from people rushing into silver and precious metals of varieties, platinum and gold, the dollar's being destroyed against hard assets. So it's getting destroyed against farmland, against real estate, against precious metals. And even to some degree, it's people are rushing into the stock market as a hedge against all of this currency chaos that's coming from central banks.
So, Michael, one of the other things I'd like to ask you about is how interest rates and inflation kind of play together to destroy the actual purchasing power of the dollar. Okay. So my portfolio now is 20% long precious metals, which is pretty much the highest that this portfolio will ever go. 25% is probably the highest it'll ever go. And precisely because the dollar has topped out on a trade-weighted basis. Our deficits are through the roof. I mean, if you look at the debt, as I mentioned, the deficit, 4 or 5 trillion, but the national debt, Tom, is now 850% of our revenue. I don't look so much of debt to GDP, even though it's well over 100% now, the national debt. You can't tax, if you tax the GDP at 100%, there would be no GDP. That money is not available to you. I look at the ability to pay off the national debt predicated on revenue. And the revenue now, the debt is 850% of the revenue. And not only that, but the deficit. So if you just make it like your house. So if you have $100,000 income and you have this $850,000 in debt, and your deficit is $130,000. So forget about the fact that you can't pay off the actual debt that you have. You're adding to that debt of 130% of your revenue. I mean, that should scare the crap out of people. We're an insolvent nation. So you have the dollar topping and falling over. You have the national debt, which shows that we're a bankrupt nation, along with all the other disgusting sovereign nations that have destroyed their fiscal and monetary policies. But then you look at real interest rates. So let me just spend a minute on this. So nominal rates, real interest rates are nominal rates minus inflation. Nominal rates are 0%. And even if you go out 10 years on a sovereign U.S. benchmark bond, that rate is 0.5%. It's a half of 1%. So nominal rates are virtually zero across the entire yield curve. And then you have the asinine concept from Mr. Powell, and it's been universally adopted by all central bankers, that somehow stable money means 2% inflation. So you're virtually guaranteed to get minus 2% real interest rates. So if I take and gold as a currency, it competes with cash. So if I put my cash in short-term debt, or if I put my cash in the bank, I'm losing 2% at a minimum. Because don't forget, they want inflation to go to 2% and then to be above 2% for a very long time to make it symmetrical to how many years they were below their 2% target. So let's just say real interest rates right now are negative. They're heading to 2% and then going to minus 4%. But that 4% is how the Fed measures inflation by core PCE metric, which takes out everything that goes up. So substitution, hedonics, the Fed measures core PCE at 4%, taking out food and energy and everything that goes up. Then you can better believe that the real rate inflation is closer to 10. So real interest rates are going close to double digits in the minus column. And you're going to tell me you don't want to own some gold in your portfolio or some silver or some platinum? It's ridiculous. It's absolutely insane. Spiking deficits, plunging real interest rates. You have to own gold. I start with 5% in the portfolio, and I toggle that between 5 and 20, 25%, depending on the macroeconomic condition. And we're about as favorable for gold as you can possibly get right now at this moment. Absolutely. There's kind of 3 main things you outlined, which we've kind of touched on. Mm-hmm. The rising debt as a percentage of GDP, the dollar is rolling over, and falling real interest rates to make the perfect environment to own gold. So how do you go about thinking, Michael, about how to quote unquote own gold? Do you kind of spread that across ETFs or physical? How do you go about thinking about where to put that?
Okay. So I said the minimum amount of gold that I recommend owning is 5% physical gold. And when I say physical gold, I don't mean a physical gold ETF like GLD or AAAU or something like that, Sprott. I don't mean that. I mean physical gold that is in your possession that you can get your hands on immediately without any third-party involvement or permission. So people say, I have X amount of ounces of gold in a vault in Hong Kong. Well, is that really what you think is available to you during times when you might actually need gold? Collapsing economies, collapsing countries, sovereign chaos. Are you going to call up Hong Kong, which has been, taken over by the Chinese government and demanding your gold back? And that goes to, I don't care where your gold is, if it's in Toronto or if it's in New York vault. I think you should always start with 5% physical gold, which you can get to. It doesn't have to be in your home, but someplace where you can get to it without having the permission of a third party. Okay, that's number one. Then I use the investment spectrum of gold, which is physical ETFs and the miners. So when gold's in a raging bull market, you want to have some miners in there, maybe some silver miners and some gold miners. They're a leveraged play on their gold in the ground or silver in the ground. So if gold is in a bull market, these miners will do fantastic. If there is a bear market in precious metals, then you're going to want to run for the hill. You want to be short these mining companies because they get destroyed. I'll remind people that, even though we're having a great time today, from 2011, 12 to 2016, miners fell 85%. You have to have a model that understands when to own these mining shares and when to get out of mining shares. So between actual physical gold, ETFs, physical gold, that I give exposure to physical gold, and the miners. Those are the three ways you own gold.
Excellent. How much consideration do you give towards silver? The last couple of days, we've seen silver rocket up, just the physical spot price, up over 15%. So do you try to weight one or over the other?
I do, absolutely. And I've been right on this up until like a month or so ago. I've been very clear to overweight gold vis-a-vis silver because silver has a monetary component and an industrial component. And since I'm not at all sanguine about the growth of the global economy, as a matter of fact, as an aside, mentioned that all of this debt that we're raising, which is absolutely mind-boggling, $72 trillion total U.S. debt. Corporations are raising debt at a record pace of never before seen. We were already insolvent as far as corporate debt is concerned, record nominally as a percentage of GDP. And now we're adding to that exponentially because of this virus. So, there's so much debt in the world that we're defaulting all over the place. So silver is an industrial component, and I do not think that you could be very bullish about the prospects of growth in the world because guess what? All of the debt that I was just talking about has been of the unproductive variety. This is not debt that's taken out to engender capital goods, to produce growth. The building blocks of growth are capital formation. None of this is for capital formation. It's helicopter money to keep people solvent, to continue to boost consumption. So we're not going to have any growth. So I'm not favorable, and I was right. I haven't been favorable towards silver. But when you look at how depressed silver is vis-a-vis gold, the gold-silver ratio, then you add to that the fact that silver is a great bet if you get a Biden presidency because there's a big move, not only in the United States, but an inexorable move globally towards green energy, which requires solar panels, which requires a lot of silver. So even though the amount of silver in solar panels might be being attenuated over time, the number of solar panels is exploding. So what I'm saying is I'm becoming a little more favorable on silver as well.
Interesting, Michael. Before I let you go here, as you're talking about the possibility of a Biden presidency, would you like to get into a little bit about how you see what factors are going to go into the election in November?
Well, I can tell you this, Tom. I'm 57 years old in September. For the first time in my life, I am absolutely concerned about the stability of government. And let me just elaborate on that for 1 second. So normally the parties are very contentious, but in the end of the day, we have a constitution and power is turned over very readily from one party to the next without event. But I cannot remember ever seeing the antipathy that exists between the two main parties in this nation. And then you hear talk about Trump may or may not accept the results of the election. I'm hearing, one Democratic mayor is at odds with the federal and state government. The mayor of a city is at odds with the governor of a state and D.C. And sometimes they're getting into physical confrontations. And I think this election is going to be very, very close. I mean, I know Mr. Biden's ahead by 15 points in the polls, but I think there's a hidden Trump vote out there as well. So I think it's going to be much closer than people think. And the way this country is being bifurcated between constitutional conservatism, whatever's left of that, and a new branch of socialists and communists who actually hate the foundations of America. They're tearing down our icons. They want to remove George Washington from the currency. They're tearing down statues of presidents. So I've never seen anything like this before. Maybe 1968. I was only 5 years old, but 1968 was a very contested primary. But in the general election, it went much smoother than what we see today. So I'm worried. I'm worried about the Constitution of this United States and its ability to stay strong, given how bifurcated this country is becoming.
Excellent, Michael. Well, I think that's a great place to wrap up. Maybe just share with us a little bit about where we can find more of your writing.
Sure. So my website is pentoport.com. And, the number for the office here is 732-772-9500. You can also email me directly at mpento@pentoport.com. If you have around, say, $70,000 to $100,000 to invest, I try to be the hedge fund. The rubric here is an RIA, but I run the money like a hedge fund. I try to be the hedge fund for the average guy. Normally you need $500,000 to $1 million to get involved in a hedge fund, and they charge 2% on your assets under management and a performance fee of 20%. I don't do any of that. I charge just 1 to 1.5% on assets under management, no performance fees. If you have some money you want to invest, that it can be intelligently invested, geared towards the second derivative of growth and inflation in the economy. You'll be able to hopefully participate in the upside of this massive bubble. You didn't ask me, and let me just mention real quick that the stock market today is the most expensive stock market in the history of this nation. It's 156% of GDP. The value of equities has never been more extended above the actual economy, ever. You don't have to wonder why that is. Just think about the massive fiscal and monetary falsification of these asset prices.
And maybe just mention, too, that something like 22 or 44% of that entire value is wrapped up in the 4 or 5 FANG stocks, correct?
3, yeah. So if you look at 3 stocks, so Apple and Amazon and Google, if you look at their market cap, those 3 stocks are equal to 25%, 1/4 of the entire gross domestic product of the United States. I mean, that has never happened before. It's completely asinine beyond belief. But what happens when you're a pension plan and you have to make 7% per annum returns, and guess what? You can only get 0.5% on a 10-year note, and you can get only 5%, Tom, on a junk bond, 5.5% on a junk bond, which means, many of your bonds are going to default. So you're not going to see 5% at all, not even close. So, of course, people have been rushed into risk, forced and pushed into risk assets. So if you want somebody that can hopefully participate in this bubble and also protect you and profit your assets on the downside, I have a very good history of modeling these cyclical and secular crashes in the economy caused by deflation and recession, then this is the place for you.
Excellent. I also suggest for people to subscribe to your weekly newsletter as it shares some great insights.
Right. I'm sorry I didn't mention that. I have a weekly newsletter called the Midweek Reality Check, and there's a trial basis, 5 weeks. It's $49.99 a year, $49.99. So a penny less than $50 a year. And you get my insights, independent thinking, the real data that you probably won't find in the mainstream media. By the way, one of those data points is you probably won't hear well promulgated is that continuing jobless claims came out today. There were 32 million people still collecting unemployment assistance from the government. So the headline number says, 16 million. No, that doesn't include pandemic unemployment assistance. So when you add the 2 programs together, 32 million people are getting a check from Uncle Sam every week. So, those kind of data points, that kind of analysis, and I'll give you a general idea of when it's time to get long sectors and what sectors to get long, what style factors to get long in the podcast. But if you want me actually to manage your money on a daily basis, then you have to come here.
Excellent, Michael. Thanks for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?